second step of 3 steps in the system is that in order to participate in all of these markets, U.S. markets, foreign markets, emerging markets, real estate, bonds, you want to minimize your fees and your taxes. That way, you can harness this law of compounding. How do you minimize your fees? What you do is you buy index funds. And at Market Riders, we use a new type of index fund called an ETF, which is an exchange-traded fund, which you can learn about on the site. Basically, an index fund is a very simple vehicle. It says that instead of trying to pick the right stocks in a particular market, we as the index fund provider are going to sell you a single security that will own all of the stocks in that particular market. We don't have to hire any experts to pick stocks because we're simply using a model of an index. For example, in the S&P 500, Standard & Poor's of S&P tells you what are the 500 stocks to own the 500 S&P. So the index fund simply buys all 500 of them in whatever proportions Standard & Poor's tells them to do as the index. So because an index fund has no decisions to make, they can charge very, very small amounts of fees. John Bogle, who started the Vanguard funds, which are now the second largest fund company in the country, began the whole concept of an index fund. In fact, Vanguard is a non-profit organization because Bogle believed that Wall Street was ripping off American workers so bad, he just couldn't take it. His innovation was the index fund. The index fund is simply a basket of stocks. I believe the S&P 500 index fund is 0.07%. You're simply paying for the computer to run the basket of stocks. At Market Riders, we use ETFs, which have advantages as an index fund. You can buy them cheaper. You can buy them at any discount broker for $10, whether you're buying $1,000 or $100,000 or $1 million. You can buy them for $10. They trade all day long, and there's some tax advantages. ETFs are now coming out in any market that you want to participate in. And again, they simply mimic the market. So when you own an ETF, you're going to pay very small amounts of fees. In some of the templates on Market Riders, the entire Market Rider portfolio might cost you 22 basis points, which means for a $100,000 portfolio, you're going to pay $220 a year to the various ETF providers to index the markets that you've chosen. The second and more interesting way you save money is the tax aspect. If you owned a bunch of stocks and some of them, like Apple Computer today, began to run, would you have the stomach to hold it for years and years and years while it goes up and down and could be as volatile as 20% down one year? Most people don't have the stomach for that, and so they sell stocks and they pay taxes. And your money managers and your mutual funds are selling stocks and paying taxes. But when you buy an ETF or an index fund on, say, the S&P 500, why would you ever sell that stock? Well, if you needed money, maybe you'd sell it. But generally, you're going to want to be exposed to the U.S. stock market for the rest of your life. Therefore, the power of the ETF is you're going to buy and hold, maybe forever. When you can buy and hold forever, you harness the law of compounding because each year's returns continue compounding into the next year, into the next year. And you're not paying taxes on those gains as the years roll by. Instead of giving the money to Uncle Sam, they're staying in your investment account and they're compounding and compounding, giving you those returns and not the government and not Wall Street.